I do like to start off every show with a summary of kind of what I saw happening this week in the market. So we'll start with that, switch over to this chart. All right, Easton. So we've been looking at this chart. We really started this chart at the very beginning of 2022,
Yep.
right? And we've been watching this thing came all the way down, and it's pretty volatile. The very beginning of that chart, that's a lot smoother, is 2021.
Hmm.
That was an incredible year, actually. I think there was, up until the very end, there was no 5% drops in there. It kind of went straight up, but hasn't been true since then. We hit that top. And so what's different about today?
Oh, look, we finally broke that top.
We finally did. We've been talking about this for over a month now about, breaking through to a new all-time high. Last Friday, we actually broke into the all-time high, during the day, but we didn't close there,
Yep.
right? So today, that's what they call the intraday, high. Today we broke the intraday high already because we're at 43.38 ish,
Yep.
and the high was 48.18,
Yep.
give or take. And so we're 20 points above that. So we already did that. That's in the books. We have to close above 47.97, which very likely to do at this point, with this much motion. And as soon as we broke through, the market did move pretty nicely.
Yeah, it's gone up quite.
Yeah, it's not quite a green shirt day. For those of you who don't know, green shirt means that the market was up more than 1.5% or more for the day. Could get there. Market hasn't closed. We'll see what happens. But it's a kind of the breakout that we were hoping for.
Yeah, it was kind of just bouncing against that resistance for a while, and now today it's finally broken through.
Yeah, and you can see that, where we got close. Just if you look at the chart that's kind of right over Eason's head there, that portion, it was bouncing off of that high. That's what they call resistance, right? So resistance means that there's a bunch of people up there that might have bought at that price that would like to get their money back, right? So it gets back to that price. They start to sell. And if you keep hitting up against it like you're doing, it's a good sign that you're probably going to break through because every time you go up, you dry up a few more of those sellers, right? And what's cool about now, there is no resistance.
Yep.
The market's never been here before. The only resistance is just literally overpricing, overstretch, and those types of things. At the moment, we're not as overstretched as we were. From that run from, end of October to really the end of this year, it was so stretched out.
Yeah.
But we spent the last month essentially going sideways, which kind of settled things in a little bit, gives a little bit more room to the upside, so I wouldn't be surprised to see some run here. It is somewhat important to break into a new high, just because on a technical basis, you can get what's kind of a bad looking chart when you have two tops, the double top,
Yep.
right? And so still need a few days above that to say that we're really, not hitting a double top. You can get these false moves on one day. So, temper our celebration a little bit, but still, I think that that's going to happen. The key is that the Federal Reserve seems to be, at least at the moment, done raising rates for a while.
Yeah, they've kind of set expectations that they're waiting until the second half of the year to actually, if they're going to make cuts, make cuts.
Yeah, that's one of the problems the market's having. I mean, to talk about this week, Monday and Tuesday were down this week. Matter of fact, in both cases, they were down a fair amount during the day and then kind of rallied up a little bit at the end. And so, all of a sudden then by Friday, we're setting a new all-time high, right? And the reason that market was down, I believe, earlier this week was that, the market is expecting a rate cut in March.
Yeah, the market last week was, majority of the people thought there'd be a rate cut, but now that March has shifted, now that it's actually most people are expecting them to hold rates in March.
Yeah, exactly. And so they have a meeting here in January that was always expected to be a hold, in January, no rate increase. And, the next meeting would be March. And so there was this expectation. When I first saw that, it got up to over 80%, I believe, was the high point for that. The likelihood of a rate cut in March. I thought that was kind of wild because rate cuts are usually precipitated by something that kind of makes that happen. And, you need to see some softness somewhere. Back in the 60s and 70s when they had higher inflation for a while, and then they got it under control a little bit, sort of like they started to have labor issues, right? So the job market started to soften up, and so they lowered rates. And of course, then inflation went crazy
Yep.
and really got out of control. But we're not seeing that here. Matter of fact, this week we had one of the lowest
Unemployment claims.
first-time unemployment claims that we've seen in quite a while. Retail sales this week came out for December. They were very strong, much better than expected. So, I mean, I don't actually see where this rate decrease is happening. It could be from a deflationary standpoint, right? But we're still not even seeing that. We still have inflation. If you look back again, at the different measures of inflation, you look at the last 6 months and you annualize that out, multiply it times 2, we're pretty much already at the targets if we can do that. And so maybe there's some thought that you want to lower rates or a little bit, so that because you don't want inflation to turn into deflation, right? And the challenge for the Federal Reserve is always the same. The changes that they make, whether they're increasing or decreasing rates, take time to have impact. So by the time you see things deteriorating, you want to, already have done some rate decreases in that particular case. And I think that's what the market's looking at. However, the market has been stuck in this loop since this whole thing started, it seems to me, of this kind of normality. Let's look at the data from the past. When they raise rates this much, right, then the market falls and we have a recession. Period. I'll buy into that. I mean, I've seen it enough. I saw it in 2000. I saw it in 2008. And you see these giant things, and then something breaks, like Lehman Brothers. All these things happen. But of course, the data doesn't include a pandemic. The last pandemic was so far back that the data is not really relevant to what we're dealing with today. And really, what's driving this whole thing is the consumer continues to go out and spend money. And right now, one of the things that's really fascinating to me, the job market is strong. There's still over 8 million open jobs, right? There was 11.4.
Yeah, so it's softened some.
It has, but I think it was 8.8 million was the last I saw. That's still, like, if you look historically, that's an amazing number of open jobs. I mean, it's huge. So you've got that going on, but wage growth right now is in the 4 point something range, and inflation is in the 3 point something range. So we're actually getting wage growth that is going faster than the rate of inflation, which is good, because we have a big period of time here over the last 18 months where that wasn't true.
Yeah, people are feeling the crunch, basically.
Yeah, rightfully so. If inflation is 6, 7, 8, 9%, and you're getting a 4% increase, you're really struggling with that. And so, but that's not true right now either. So that's also supporting the consumer and consumer confidence to go out and spend when they are getting more money and have more buying power, right? So really, really incredible time, actually. Very fascinating to me how all this is played out, and what will happen going forward. So the big conversations this week, outside of kind of the retail sales, earnings were very good. Semiconductor companies have gone wild here.
Yeah, this week has been a run. Supermicro, which is a server company, who does basically a lot of data centers with AI, they provide a guidance of where they were, or they increased their guidance, their forward guidance, and they're not reporting till I think the 29th this month.
Yep.
But based on just that, increased guidance, they jumped 30% today.
Yeah, and really, there's a lot going on in the AI arena, and it's pretty much starting, it seems to me, in the semiconductor arena, because to really go through these big data sets, it takes a lot of semiconductors, and that's a big deal. So you got billions of dollars being spent in this area, companies with like NVIDIA and what have you, and so what we've been seeing, in my opinion, the last 3 quarters at least, the semiconductor companies are really running during the earnings season, specifically, and sometimes they don't run as much outside the earnings season. And what that means to me is that the analysts and the Wall Street, view of what's happening there is too conservative for what is that. So they're coming out and eventually reporting, like this, Supermicro reported early, but they're reporting, hey, things are going fantastic, and we're actually going to up our guidance, as far as that goes. And so they're slowly catching on to that, and we're seeing some runs in those particular stocks. There's an ETF called SOXX, or its ticker symbol is SOXX. It's an iShare semiconductor index. was up a little over 3% yesterday, up a little over 3% today. So that's one of the places that runs. And uh, back in, I think, about May of last year, we saw the same thing with
Yeah.
NVIDIA's, reporting of earnings. So we're seeing tech as a whole running here right now. It's definitely been kind of the winner here, at least in the short term. We have a lot of tech in our portfolio right now because of that. We try to ride the waves as long as they're going, as far as they will anyway. And so that's a big arena right now too. I like tech leadership. There's a lot of really sound companies with phenomenal products and great cash flows, and really good profit margins that are out there in that arena, and they pretty much dominate these big indexes, right? I mean, when you really look at who's at the top in size, an awful lot of tech companies fit
Yeah.
there. Now, will they continue to be the greatest thing on sliced bread, forever? Not always. Sometimes what was, like you were saying today, what was in the best the last 10 years may not be the best the next 10 years.
Yeah.
Um,
And it's kind of crazy, like, but honestly, if you want to see it, you want to see a broadening, right, to other companies. You don't want to just see only like, a small subset, running.
Yeah, I mean, typically what you would see in a normal market recovery like this is you would see large cap companies doing well. In general, right now, most large cap companies that are in these indexes, they're dominated by tech, right?
Yeah.
And then that would start to spread out to more mid cap, and then eventually you get the big small cap runs. But that's like a 5 year cycle. And so if we say, hey, this cycle started in October of 2022, we're just really, a year and a quarter into it, so to speak. And so it's still, and the reason that is because it's risk, right? So people would look at a Microsoft or an Apple and say, okay, that's a certain amount of risk. I could
Yeah.
have my money at the bank, but it's less risk than XYZ company over here that's making something, whatever it is, AI or what have you. But eventually that risk, if you watch what happened in the 2000 upturn, and again, I'm going to mention this again, you got a combination of a pandemic, which is somewhat credited with the Roaring Twenties and one of the best 5 years history in the stock market. And then, of course, we got the dot-com arena from 95 to 2000, which is the best 5 years in the history of the stock market. We have both because we have AI, which is looking a lot like dot-com to me, and just in terms of how it works and kind of where that frenzy might end up. So if it plays out the same way, I'm very familiar with the dot-com run. I was here working on that, every day, and if it plays out similarly, it'll be the large cap companies first, the Nvidias and what have you. Then it'll start to spread, and by the end, we'll be hearing about all the little companies we've never heard of before that are going public that are AI companies, and then there'll be a big washout, right? I mean, that's
Hmm.
the normal cycle.
Yep.
And then you end up with the winners out of that, the Amazons and what have you. And I remember a story in the 2000 I still think about, that in Detroit in the very early 1900s there was 2,000 car manufacturers,
Yep.
because that was the .com, right? That at that
Hmm.
time, right? It was making cars, and Henry Ford, and the ability to make mass produce relatively cheap and those type of things. Of course, you had to have the roadways. Right now we have the silicon, right? We have the chips that allow AI to kind of work in these big data sets. So if it plays out that way, you can do really well. It'll float a lot of boats. It'll make the market go up. You've got to be careful at the end.
Hmm.
When it starts to get really narrow, because that's what happens in the end. It starts to get narrow again, back into just small little groups of companies, and a lot of, I mean, Nvidia could be languishing at the end of this, even though they're
Yeah.
still selling a lot of chips because everybody's buying these other areas as far as that goes. We do have Bitcoin, right, this week.
Yeah. Bitcoin ETFs were finally allowed, and
Right.
that's been on the market now. People are able to buy it.
Right. And so it'll be interesting to see what type of impact that has, because there's only so much money that's out there.
Yeah.
It has to chase different things: bonds, stocks, real estate, and Bitcoin, futures, markets,
Money
currencies,
markets.
money markets, CDs, right? I mean, there's a lot of places money can go, and really, if you're a stock market investor and you're buying the S&P 500, the more money that can be attracted towards the S&P 500, the better. That's why breaking into new high, that's a good thing, right?
Yep.
Kind of like marketing in a way. So anyway, that's what happened this week. A good week in the end. Started off poor, but the data has been good. I would say that the data is so good that we still need to worry a little bit about inflation, right?
Hmm.
Because it still could be coming at us and still could hold up higher for longer, type of thing on the inflationary standpoint. So those are the things we watch. it did kick back even further, in my opinion, any threat of a recession.
Yeah.
Right? Because you got, such a good retail sales report and other things that just continue to come out as we're heading into the meat of the earnings season here. And I wouldn't be surprised if it isn't pretty good again.
Yeah,
You know?
we can see, I think PCE that comes out probably towards the end of the month will be a good indication of where we are. Because PPI and CPI kind of had a conflicting
Yeah.
answers.
CPI, Consumer Price Index, talked about that last week. Wasn't that great, actually. It was up a little bit. I didn't think it was spectacular. If you dig in, it was mostly shelter and rent and things. So that's a weird part of that index. The PPI, which is the wholesale index for inflation, was actually good, better than expected. So I think the tiebreaker here is going to be PCE.
That come
A lot
out.
of acronyms, but that's the big one to me. That's the one the Fed's looking at too. That comes out at the very end of the month. Huh?
Yeah, it comes out next Friday actually.
Oh, next Friday. Perfect. So we'll talk about that at the next show. Okay, good. So that's what's happening. Thank you for joining us for the summary. Really appreciate it. We'll look forward to again, doing it again next week.